Welcome to the Green Lantern Capitals webinar. We have with us our CEO, Mr. Nilesh Doshi, and Managing Partner and Senior Fund Manager, Mr. Abhishek Bharadwaj, to share our thought process on strategy and view going forward. Hi, Nilesh. Over to you.
Thank you, Nitin. Welcome you all on this webinar. Since we are seeing quarter one result has been coming out and almost 1 month has passed, we thought that let's have this webinar to share how do we see the markets going forward. So just let me take to a recap that for the past more than a year, we have been seeing a lot of concern in the market among investors. There are narratives that markets are extremely overvalued, and we have seen investors constantly worrying with the market whether this is the right time to invest or not. And we had our call in last April also in a very similar scenario. And we have also observed, in spite of all these concerns and fear, along with geopolitical tension, and we had two major events in our country. One is the election and thereafter the budget. And in spite of all this, we have seen the market has been making new highs. In fact, there are stocks in the businesses which have given 3x and 6x return over last 1 year. And still, all this is happening. We continue to keep getting queries and concerns from the investor that is it not expensive? Is it the right time to invest in the market? World is slowing down. India has a lot of issues. So how do we really look at the equity market as an asset class? And therefore, we thought that let's have this seminar to just share the way we think about the market. In the last quarter webinar also, we had said in our view was that if the BJP wins the election or come in the power, our view was that the market would continue to remain healthier in spite of all these global headwinds, including the high interest rate in US. And we had also shared that we will continue to see the volatility in the market. So we had also shared another view of ours saying that the option traders or intraday traders also will have a tough time because the market will keep on rising with all of worries. And that's precisely what we are seeing even today. So how do we go from here as we look at two major events in our country which, yes, would have a major impact on the market was the election and thereafter the budget. Now, as far as domestic is concerned, these two major events are almost over. Are over. Now we don't have any other than one or two state elections till next budget. I don't think we have any major concern from the Indian domestic scenario. Our economy is continue to grow at about 6.5, 6.6% on the real growth rate. And if you put 4% inflation, we are growing at 10% on the overall GDP growth rate. If I look at on the Nifty earnings side, last year we were at 1060 EPS. Expected earnings based on various consensus is about 15-16% this year. So if you extrapolate that over FY26, we are at about 19.5 times on the PE multiple for Nifty. On optical basis, this historically have been always talked about as a bit expensive. But when you look at the overall scenario in the among asset classes, in the past era, I would say about more than a decade ago, we used to have other asset classes where you can exit asset class like equity, which is a risky asset, and people could have moved to real estate from an investment perspective, or in the bond market, because typically our interest rates were in the range of 9 to 10% in those era. Now, currently with your interest rate at about 6-7% and real estate is, as of today, with the kind of supplies coming in, is not giving any opportunity from an investment perspective. Therefore, the only asset class which remains and which is vibrant, which has a lot of liquidity in the market is available is equity market. Therefore, in a scenario like this, to analyze and to view that whether equity market, in spite of, yes, there are some higher valuations, some businesses have been valued extremely high, maybe in anticipation of future growth and the earnings. Should one exit equity as an asset class and would move into other asset classes? I don't think that is the kind of scenario, as I explained, if we are going to grow at about 10% on a nominal growth rate. So on the domestic side, when we look at, we don't see any major concern on the market. We still remain positive. There are overvaluations in certain sectors. There are certain sectors which are slowing down, but sector rotation can continue to take place. If I look from the global side, we had said in the last call that we expect US inflation to cool off, and therefore we were suggesting that probably in September Fed would reduce the rate, which now probably is becoming a consensus that, and even from the Fed narrative, it is expected that the interest rate, they may start cutting from September. But on the global side, we see two very contradictory or very opposite trends. On the one side, we see US economy is slowly slowing down, I would say, and inflation is coming off. Therefore, Fed, in anticipation that they don't want the economy to slow down in a very drastic way or get into recession, would probably this time do a proactive interest rate cut, and their inflation target of 2.5% is coming closer to meet. On the other side, what we are seeing is geopolitical tensions and cycle of war is rising. We saw Ukraine-Russia war, but now we are seeing second front that is getting opened up, which is Israel, Iran, and that belt. So the cycle of war is showing its head out, and the economies like Europe, Japan, and now US is expected to keep slowing down. Though the pace could be different, but that is I would say a little concerned scenario that their economies are slowing down. But at the same time, market typically looks at that with Fed becoming proactive and cut interest rates, how their economy will pan out. Fed will be able to control and ensure that the economy doesn't get into severe recession. In case there could be a little more slowdown, but it will not lead to any kind of a massive deflationary scenario. And therefore, in anticipation of that, the market is still continue to hold in the Western world. So from the external front, we see that again the same, that market is continuously going up on wall of worries and optimism, as well as there is a pessimism. So there is a fear which is coming because of cycle of war or any kind of incidences. And at the same time, there is optimism which is pouring in with the Fed rate cutting coming. Fed expected to start reducing the rate somewhere sooner, and they will continue to support the use the monetary tool to support the economic activity. And we also feel that in a scenario like this, overall net market will definitely remain positive. There could be some sideways movement. The correction can happen because the valuations optically, as I said, or on near-term basis are high. But then overall, we don't expect even globally that the equity as an asset class will be, people would exit or dump the equity as an asset class, or there would be a massive crash in the market. Having said this, the way we also look internally is that there are sectors of opportunity. There would be sector rotation. There are sectors. What we have observed in last 2, 3 years also that there are sectors which have underperformed or where the growth rate has reduced. These stocks in the sectors have not collapsed or people have not exited those stocks at all. The stocks could have gone sideways to 20-30% correction and remain sideways. And then again, when the next cycle comes, that those stocks may start doing well. So maybe in a very similar way, we can expect a similar thing happening, that what market is trying to indicate to us is that it's not that you sell off equity and run away. There could be, you keep looking for opportunities, keep looking for businesses which are turning around, and I think those are the pattern which is suggesting, and that is why we have seen also in last 1 year that there are stocks with a bottom-up approach, or there are stocks from a top-down sectoral approach have given a phenomenal return in the last 1 year. We at our end also would attempt to do the same, and we feel that that's probably the trend may continue in a similar way as we go forward. Correction to talk about. So far, the market has said sectoral corrections and not across the board or on a nifty level, except for the 4th June of the election result. We have not seen any major correction in the market, and then market bounces back immediately. So sectoral to sector correction, like what we have seen in FMCG or private banks or consumer durables, or in case of chemicals, in case of textiles, we have seen, maybe we can see a similar kind of a pattern in other sectors. But then there are many more sectors where there is a lot to be done in our country, and those sectors and the stocks within those sectors and some bottom up will continue to give us a good return as we go forward. On the time horizon, there could be questions that when we can expect correction. Obviously, no one knows when the correction can come. But in the last call, we were probably hoping that we may see some correction in month of around October, November, which now the way the markets are moving and markets are actually volatile with intra corrections, I would say is that one day market goes up, one day goes down. Probably market is getting into this kind of a complex pattern where a time correction with a little sideways appears to be what it's trying to happen. We will, of course, we will observe how things really unfold. And that's the way we think that it would be easier to navigate rather than talking constantly on the on a broader scale, talking of global concerns or economic concerns, and then stay away from the market. I think the last 1 year, since people have been worrying constantly, has proved to be wrong for the people who remain on the sideline. And those who remained at least reasonably invested have done well in this market. That could be the trend we believe could still remain for some longer time. There are sectors to touch upon is still, for example, energy sector, both on the oil and gas side or on the, oil and gas side. Okay. I think there is some issue with my screen. Fine. Yeah. So energy is one sector, both on the renewable side, on the fossil fuel based side, we feel that we have not yet scratched the surface of execution, implementation, and there is a lot more to go. Even on the energy side, when you look at globally, simultaneously, all the countries are seeing a shortages in the supply of energy, especially with the data centers, AI, electric vehicles. From all this angle, the demand for energy is rising globally. So this is one sector where we still feel that we haven't scratched the surface. Oil and gas side also is another area where a lot things to be done. On the manufacturing side in India, particularly on defense, railway, infrastructure. So these are the sectors which we believe that will keep on giving a lot of opportunities as we go forward. So overall, to summarize, before we go into question and answer, is that at this juncture, we still don't see any kind of major concern or major crash kind of a scenario in the market. The liquidity is equally very high from a lot of new participants in the market. Volatility will continuously remain high, and therefore, we, like what we said in the last quarter, we maintain our stand that people should avoid trading and option and especially options also. Focus on businesses, focus on stocks, valuation, and stay invested. I think the return would be definitely better than other asset classes. And we will see as things unfold because we have one major event now, or I would say two events. One is on the US Fed side, which sort of getting baked into the expectation of interest rate cut. And the second major event is the US election. So once US election, till that time, we don't see much of a concern. Post that, we will have to evaluate again what kind of policy structures and how the US economy is navigated by Fed and the new government. On the geopolitical side, again, I am sure people would have questions on these kind of confrontation in Ukraine, followed by, I mean, in Israel and Iran. We believe that, yes, these kind of activities, the signs are not good on the longer term. But in the near term, we don't think that these kind of happenings would escalate into any kind of a major global scenario. Probably this would remain localized and regionalized. There would be some sanctity would keep coming and going among the world leaders, and there would be attempt to cool down these kind of confrontation. And we have to live with this. This will definitely lead to volatility in the market and in the behavior of the investors. But probably we'll have to live with. We don't see this culminating into anything big, at least in the near term. We will see if anything such thing is happening going forward. But at this juncture, we don't see. Yes, this would give a lot of volatility in the market, and which, in fact, if you're not an investor, if you try to trade, probably this kind of events are going to be hurting to the participants in the market. So, as I said, the only challenge what we see could be in the market is not much from the cycle of war, but more from the economic activity in the Europe, which is obviously it's in recession, some of the countries, and largely from US. So what needs to be we would be watching constantly is that post the Federal Reserve interest rate cut starts, if it starts in September, post their election, how the US economy is being is basically their growth rate and the overall economic activity, the sentiment, the capital formation, the capital flows into emerging economies like India. All that we will have to keep observe because that could be one. Some of the data point would really give us the clear indication that how the overall our economy would remain among the slowing down economies of Europe, Japan, USA. And if US economy gets into something surprisingly a very severe slowdown, then how our exports would pan out in that scenario. So this is the challenge which we have to observe. And obviously, with the data point and some early indicators, we should have to learn to figure out that how that will eventually impact our economy. But till then, till that time, we believe that we don't see yet any major roadblock as far as Indian economic growth is concerned. And therefore, we would continue to remain working towards identifying good businesses at very attractive valuations so that our margin of safety remains. Our general approach of very high margin of safety is protected. And then we'll continue to navigate in the same fashion as we go forward. And finally, I am sure all of you have our June till end June performance. So all of you have gone through, I think, July end performance, we will be able to send you maybe in a week's time. So with this, I pause here and open this discussion for question and answer.
Thank you, sir, for sharing your thoughts. We have a few questions here now. So one question is related to the changes in tax structure and impact on our investment process and churning process.
Abhishek?
Then I'm audible?
Yes.
Yes. So yes, there's been change in the tax and short-term capital gains tax as well as long-term has been increased. Per se, that does not impact our thought process or our churning. Basically, what we are trying to do here is invest in businesses and hold on to those businesses as long as we believe that the business, either the business is on track, our hypothesis is on track, and the valuation is not capturing the entire journey that we are looking to participate in. So that's our thought process. And what we have seen over last 2 years, 3 years, particularly post-COVID, is the speed of at which market recognizes the earnings growth, future earnings potential has increased immensely. It's a function of number of participants in the market, availability of information with everybody. So while one can be early, but market starts recognizing the earnings potential quite fast, and which is reflected in the increased multiples. So we are constantly evaluating that, and if we believe that a price, I mean, we've seen with our investors would know over a period of last 1.5 years, there have been stocks which have gone up 4 times, 5 times, even a couple of stocks have gone up by 10, 11 times. So again, we constantly evaluate the risk reward there, and based on where we think there is opportunity and where kind of risk that we are taking, we take a call to exit. Capital gains is something which is incidental, and we don't necessarily, our idea is to hold on to those businesses for a reasonably long term. But as I pointed out, it will be a function of market. If it starts pricing those businesses very fast, we will be booking profits. But mostly we are holding these stocks for a long-term capital gain as of now. Yeah, okay.
And so there's a question about a recent budget. So which are the most promising sectors considering the recent budget? Sir, you have to unmute yourself.
Yeah, sorry. So from a budget perspective, I don't think other than this capital gain, which was a major thing, and then simplification of individual tax structures. From a sectoral point of view, I think the strategy and the direction in which this government has been working for past few years will remain, because if India has to become a large manufacturing hub, in fact, let me take it a little differently. Internally, we have been very clear for last almost many years, and that is also one of the reasons that our fund has been reasonably doing well and have given good return, is that we have grown in this economy for last 25, 30 years from the services export and then one after other sectoral manufacturing export. But there are a lot of areas where we remain underinvested in manufacturing, and we remain a large importer of so many things. And that we have seen in areas like defense, railway, in engineering, cap goods, and so many areas. Number one. Number two, for last 12 years, post 2008 crisis, we have had so many delinquencies, or I would say the debt structure were high in many companies, and we have seen areas of energy, that is power production, steel, and many other businesses. We have seen so many bankruptcies, and therefore in order to solve these issues, we have not seen any capacity expansion other than cement, which was profitable, which remained with good balance sheet. The steel, then energy, utilities, transmission side, we haven't done anything over the last 10, 12 years. And that was also one of the reasons that our country could not grow on the manufacturing side in many areas where it was needed. So we had a very clear view that if we don't invest into energy, and if country is expected to grow at 6-7% real GDP growth rate, your power demand is going to grow at 10%. And we haven't done anything for last 12 years on any of the power production side. In fact, we are still solving some of the NCLT cases which have not been resolved. So these are the areas where we feel that irrespective of budget or no budget, country has to have these production facilities, which in turn would support other areas of manufacturing. And thereafter, we have now the new world, which is of AI and huge data analytics, and therefore data centers, electric vehicles, renewables. So overall, to answer your question in summary, is that it's independent of budget. In budget, there is no negative towards any of these areas, and therefore we understand that way that the focus and the direction of the government remain same. There is no change in that, and that is very positive. Yes, from an allocation point of view, we probably feel that the amount there is no change, or there is no massive increase in the allocation of resources towards these areas. But sometimes we look at little differently, that in our country, we have always seen a gap between allocation and the execution or implementation. So therefore, we have to first bridge this gap, where our execution capability has been definitely slower than other parts of the world, especially compared to China. And therefore, it still provides a lot of opportunity for corporates to do their capex on time. And therefore, it will reward investors. So overall, irrespective of budget, the direction is very clear that we have to have a lot of manufacturing in our country on many areas, and move economy from too much from export or services dependent to manufacturing part, and reduce your import of capital goods, lot of chemicals, etc. So I think that's the way we are looking at it. And then there is no negative in the budget towards this.
We have few questions related to our deployment strategy and cash increase in cash holdings?
Yeah, Abhishek.
Right. So I can see that few participants are asking, investors are asking why we are holding cash in our portfolio. So I think what we've been communicating to all the investors ever since we've kind of started this PMS, and almost everybody is aware that one is that three things. One is we don't follow a model portfolio approach. So every portfolio is constructed based on the day an investor comes in and based on the stocks and markets, or particularly stocks that we are comfortable with at that point in time. Secondly, our idea of investing is investing to make money. We don't have a cash deployment strategy. We are investing in businesses and stocks where we find the right margin of safety. So what we are trying to do here is look for businesses where we see sufficient earnings growth, earnings opportunity in the context of the risk that we are taking at that point in time. And since we are bottom-up stock pickers, unless we find the right kind of opportunity, we don't invest. Typically, over last 1 year, earlier it used to be when a new investor would come in, we were able to invest around 65 to 70%. As we speak, that amount has reduced now. So when a new investor is coming in, we are initially investing around 50%, and then we will build it up over a period of time as we find more ideas or some of the existing stocks become more, we are more comfortable investing in them. So it's a very dynamic number, and opportunity which market may present, we may invest a higher amount at some point in time. But cash will be there, and we have always communicated that cash is our default position. And unless we find the right kind of opportunities, we are happy holding cash in the fund.
Can we share our view related to artificial intelligence and semiconductor industries?
Yeah, I think he wants to add on the previous.
Yeah,
point.
okay. So can you repeat?
We have few questions related to industry, which is semiconductor and AI.
Yeah, so although the question is very vague, I mean, what exactly the participant wants to know about semiconductor and AI, but like in the past, era, we always used to say roti, kapda aur makan, and then came energy. I think in the new world, semiconductor is equally most important. And from a national security point of view, for ease of life, for everything what we do today is totally dependent on use of semiconductors, and in turn, huge data, and in the background we require internet, which also runs on semiconductor. So sure the person who's asking question is also aware that it's a must. Or it's a do or die situation in any country. Therefore, yes, we will see a lot of investment coming into semiconductor area in our country. We have always seen with our country is that the initial process of all this happening is little slow because the investors would want to see the government view, the government strategies, the government support, etc. And since he had election in between, which always plays a very key role in believing that what could be the strategy going forward. Now all that is little behind. We would probably see from second half of this year based on what we read and understand, we will see a lot of announcements and a lot of activity will start towards into semiconductor area. And AI is basically, we do use AI in many ways, but there are certain, especially the applications, very specific applications where we'll see AI, the use of AI is going to increase. But in the background or in the denominator, we will need semiconductor manufacturing, and we will see those kind of announcements, some technology tie-ups and everything will happen. Although very large companies like Reliance and all have definitely announced to get into that area, and it will happen. I'm sure, and I read a lot of companies are working towards it, so it will happen. Yes, it's going to take a lot of years because it's not easy to create any such facility. And then as we progress, all of us would have seen even from NVIDIA that they keep on improving their chip sizes and how many billions of transistors within one chip. So all that technology will keep improving. Therefore, it is equally challenging for the entrepreneurs who come to put up semiconductor manufacturing. Has to be very clear that what configuration and what size he wants to put in India, which will give him a longer life for the business. But anyway, overall, we see all this happening from second half of this year.
Right. More so, I think on the semiconductor, because they're in the entire value chain, there are so many players and so many segments. I think India will initially start off with the lower end of this, where you will have applications which are okay with a larger chip. So it could be chips which go into home appliances, etc., where size is not necessarily a constraint. So a chip which goes into, say, an iPhone is far more sophisticated versus a chip which will go into a washing machine or a refrigerator or a smart TV. So I think India will start off with larger ones, and eventually, over a period of time, we believe that we will graduate to something which is more cutting edge. While India has done a lot on the chip design side, I think now it's high time we start doing something on the manufacturing. On the AI side, I think it's still some time away before a lot of applications are developed. We have not got into the large language models, LLMs. And I'm not sure if any of our companies is prepared to invest that kind of money to do, but we'll definitely our IT companies will definitely do an integration job, wherein we will kind of integrate that and create products for the companies. So that's where it will move to. But I think that's also, while it's still it's a buzzword and every product is now being sold with AI, but before it actually becomes very useful, I think it's still some time away. As we have seen with internet also, that there was this 2000, there was a lot of excitement, but actual usage and actual use case was only visible after 6-7 years. It may be something similar for AI as well.
And if your question is, do we have any opportunity to invest in the sector? Initially, rather than looking at the manufacturer, I mean, any manufacturer coming with these chip manufacturing or let's say on the solar side, wafer manufacturing, before that, there would be a lot of opportunities from the equipment suppliers and capital goods suppliers. So opportunity will be there, but we'll have to look from the indirect opportunity that's going to be available, who would be initially supplying to these projects and this capex. So if your question is related to that, then yes, we will get those opportunities as we go forward.
There is a question about the US election and some state elections in India also. And can you share your view on market in the next 6 months? I think it's a very short term, but that's the question.
Yeah, so as I said about US election, who is going to win, I don't think I understand or does anyone. But the important is here that if Trump wins, we have seen his way of working in the previous cycle, and being a businessman, we can guess, we really don't know, but we can guess that if he wins, probably we would see this warmongering and those kind of things little on the back burner. And there would be more focus on the economic activity. Of course, he's a pro-American and he would look towards creating manufacturing in US and not make other countries earn out of selling to US, and he will do a really bilateral, arm twisting also. But overall, if he comes, the strategy and the policy would be definitely different, and this warmongering or those kind of things may be kept on the back burner. If Democrat comes, then probably what we are seeing today, maybe it will continue. But overall, as I said, this culminating into a full scale, something on a grand scale, I don't think that's where the world is today, because world leaders are not that with the kind of real time information flowing to global world leaders, and everybody has to. And we have seen the two elections, especially in the France and UK, which has been extremely. Nobody would have predicted those kind of results which have come out of election. I think the world leaders would not will have very good senses and would not let this kind of getting into out of control and a massive any kind of, I would say, explosion into the world because of this regional conflict. And therefore, finally, the eyes remains on, yes, US election is equally important, but also eyes remains on how Federal Reserve gets into the action and whether it prevents the further, or I would say what there are some experts talking about recession in US forthcoming, etc. Whether Fed is able to prevent that at least. And if that happens, then overall world economy will get back to on its own, and every country will start working towards its own internal plan for the growth.
The question about so our portfolio is tilted towards power sector, capital goods, and manufacturing. Do we have opportunities in other sectors as well? And can we see some green shoots in some other sector?
So I will just touch upon, then Abhishek can take it over. As Abhishek also explained, that we invest into areas where we see there is a structural opportunity which is arising. And I did explain in one of the questions that there are areas like manufacturing and power we have not done for last 15 years in this country. Therefore, it is not something that these sectors are going to, it's take 1 year or 2 year kind of an opportunity. These are really structural. If the investor follows the market for last many years, we have seen IT has been a structural sector which has been doing phenomenally well for 20 years. We have seen from 2013 chemicals, 2009 pharmaceutical, and the sectors are still doing good. So in a similar way, some of these sectors are, as I explained earlier, we have not yet scratched the surface for these sectors in terms of the requirement, the execution, the facilities to be created. And in manufacturing, all kinds of manufacturing, we are still far behind than China or any other parts of the world. Having said that, we are never like averse to in any sector. We internally keep analyzing and keep reviewing every businesses in every sectors. And as and when we feel that the visibility, the runway of business is going to be better than what it is here, and if the valuations are extremely in our favor with a lot of margin of safety, of course, we would invest into those sectors. Maybe Abhishek, you can add on to that.
No, I think that's mostly what I would have also liked to say. There are opportunities that we are seeing some segments and sectors, and we are evaluating and kind of concluding on those. And over a period of time, we will be investing in other segments as well. But it is entirely a function of one is how we are trying to create portfolio at that point in time. The idea is, of course, there has to be some diversification, and we try and build a uncorrelated portfolio. Beyond a point, we don't want too much concentration into particular sector, but at the same time, underlying companies should be witnessing significant earnings growth, something which has not been captured already, discounted by the market. So with that in mind, we have certain stocks and sectors, and you will see more of this.
I think we have a question about earning growth of our portfolio stocks. So overall portfolio level, what's the earning growth and what kind of upside versus downside do we have?
Right. So from an earnings growth perspective, our portfolio will is likely to witness over 20% earnings growth. Some of the stocks will be witnessing much higher than that. And then there are certain larger companies which may be mid-teen sort of growth. But overall, it should be 20% plus growth. Nitin, what's the other question? What kind of upside and downside?
So valuation, re-rating or de-rating, do we have any view on that? So portfolio upside, basically.
So of course, the idea of when you buy some of these businesses, our idea is that at this particular point in time, market has underestimated the earnings potential of some of these businesses. What typically happens is when sales is increasing, you would witness earnings growth, which is likely to be higher than the sales growth, because there will be operating leverage as well, or there could be margin expansion also, gross margin expansion also. While stock price increase that is the expectation that a stock price increase will be higher than the earnings growth as well, because you will see a multiple expansion as well, earnings multiple expansion as well. So when we are investing in most of the stocks that we are invested in, and we are quite comfortable with their earnings potential, earnings growth potential, we believe that there is a good upside potential in most of them, and the market has still not fully appreciated the earnings growth in these stocks. Is there a downside risk? It is always there when you're investing in equities. It is by definition, one needs to understand that it's a business of probabilities, and with all your homework and everything, you are still dealing with future. Can things go wrong? Yes, of course, things can go wrong. There could be something with the domestic government, something global can happen, and which could lead to impact on the earnings potential as well as de-rating in stocks. So which is always there, and in equity investments, one can never deny those things. Just that we are invested in businesses where we believe that the risk reward is favorable for us.
So this question is related to the position sizing. Is it not a good idea to deploy cash in invested ideas during market fall?
Right. So if there is a market fall, then why not invest cash?
Yes, in the same existing investment ideas.
So here we're reasonably disciplined with our position sizing. So typically we start, as we have communicated to all investors when we have onboarded them, typically we start with a 5% position, and only when we are extremely convinced and the stock is liquid as well, we may go at our cost, go higher than that. So typically that's our comfort level, between 5% and very rare a couple of percentages higher than that. While because of appreciation and what we have seen over last couple of years, that stocks have moved up very sharply. Because of their increase, they may become a larger proportion of the portfolio, but that's our typical starting position, and that's how we like them to be. So increasing percentage of in a existing position is not something that we are comfortable with. What we believe in is that in this market, because we believe that markets will keep presenting opportunities, there'll be enough opportunities to diversify your portfolio and invest in stocks where you have your right kind of margin of safety. And when you're building portfolio, you consider all the facts in mind, and that is why. So I can see there is still some discomfort regarding the cash levels. I think what is important is for the risk that we are taking and the returns being generated. I think the cash should be left to the best judgment of the fund manager. It's a portfolio decision. It's again a conscious decision. As I have earlier also pointed out, this is our default position. So one should not look at this in an isolation that if everything was invested, then how would returns look like? I think when we are building portfolio and we are buying into stocks and considering the beta of the stocks, we are considering the cash positions also that we are holding. Rest assured, at the right time, we'll be investing and deploying the cash. But the cash that we are seeing is there as a conscious decision.
So broadly, more or less, we have covered. There is one last question. Government seemed concerned with private capex not picking up. Do you think companies are not seeing the demand on the ground and are not very enthusiastic about capex push?
So it's a very sector specific, but that's how typically that is how it happens also. Honestly, yes, government concern is something which is valid, but at the same time, capex from companies happens in sectors. Like it's the responsibility of the government, or government is expected to create infrastructure which reduces friction for manufacturing. Overall, it reduces your cost of production, your time to market reduces, your inventory time would be lower. So basically, it makes you more efficient, your operations more efficient. As companies gain more confidence regarding policies, about stability of policies, stability in government, infrastructure improves, private sector invests, and it will invest based on. So when you start creating a manufacturing system, first you create at the higher level, and then you start creating the entire ecosystem, that is tier 1 supplier, tier 2 suppliers. So all of this capex will happen, but I think it's a unlike services sector, manufacturing sector and overall capex is a very gradual process. While some of the earlier investments, as in erstwhile sectors where capex used to happen, which was cement, steel, etc., that continues to be there. Large scale investments which used to come in power sector, I think from what happened in the last investment that private sector made, and which led to large scale NPAs, which we have witnessed from 2013-14 all the way to 2020. I think private sector is still a little nervous about committing to very large scale investments, which will impact their balance sheet. So it will, I think, happen over a period of time, gradually, as demand comes in, as they have more confidence about stability and continuity of demand. then private sector will come in. So we are not unduly worried about private sector investing. I think eventually it will come. It's just a function of the right time, balance sheet, their balance sheet comfort, etc.
Yeah, so broadly, we have covered almost all of the questions. And thank you everyone for joining us. Hope this webinar was useful. And we have tried to cover our view on domestic front and as well as on the macro front. And we will again conduct it after 3 to 4 months. And definitely we are going to share all the details. Thank you so much everyone for joining again.
Yeah, I mean, do write to us if there is any feedback, you want something more to be covered, then please contact one of us and we'll try and do it in the next one. Right. Thank you, everyone.
Thank you. Bye-bye.
Thank you.